Hello, Mr. Murthy. Good evening. Welcome to the show. How are you, sir?
Oh, I'm fine.
Thank you for your time. Sir, our viewers would like to know what's your view on the union budget and, the implication for the debt mutual fund and, debt market.
So, the focus of this budget is on growth. So, that they have already shown by increasing the capital expenditure from 5.5 lakhs to 7.5 lakhs. The other point which is clear is that they are targeting towards having a higher growth rate, and for that, fiscal consolidation is a lower priority for them right now, which is the way to go. They want growth to happen as the growth increases in the economy and it comes at a sustainable level. Then automatically the view is that the fiscal deficit numbers will start coming down, and your debt to GDP ratio also, which is at 90% of the debt to GDP ratio of India is around 90%. That over a period of will start coming down. So what we saw is that in 1920, when your growth was only at 4%, your debt to GDP ratio actually increased, even though the fiscal deficit numbers have come down. So right now, because the capex is not happening from the private sector in a meaningful way, the government has stepped in and they have started increasing capital expenditure, and they have also given the state around 1 lakh crores of interest-free loan for the next 50 years to increase capex. So the focus is more towards capex and trying to get the growth engine humming in the absence of private sector. That is actually good over a longer period of time, but the interim period, what we are seeing since the fiscal consolidation is on the lower side, the debt markets are clearly worried. One, there were two expectations when we actually went into this budget. One was that the borrowing program will be around 12 to 12.5 lakh crores. That is a gross borrowing. The second expectation was that for the bond fund inclusion, there were certain amendments which were required on capital gains tax, so which market expected, given the huge borrowing program, they will do some work on that, and something would be announced in the budget. So both the things did not happen. The borrowing program went to around 14.25 to 14.3 lakh crores of gross borrowing, which is almost around 2 lakh crores more than what the market expected. The second is on the global bond fund inclusion. There was no mention about that. So that actually has led to the market actually selling off. One, because the view is that this borrowing program is huge. So we are not seeing this type of borrowing program even during the pandemic times. Okay. So what the view is that this will definitely lead to interest rates, especially in the long end, moving up, because the demand for government securities by provident funds, insurance companies, and banks will be around 10 lakhs. So there is a 4 lakh of gap which is there, and that will not be taken up by RBI also, because RBI is actually concerned about excess liquidity, and globally central banks are raising rates. So given this background, even though the long-term trend will be a sustainable debt to GDP ratio, sustainable lower fiscal deficit in the years ahead, the immediate concern for the next 1 year is how is the deficit going to be financed. So that actually should put pressure on the long-run yield curve. Already the yield curve has moved. The 10-year, which was trading around 665 to 667 levels before the budget, is now trading at 685 plus 685 to 690 type of levels right now. So there has been a 25 basis point of uptick in rates after this budget announcement. And the expectation is the yields will go above 7, the 10-year yields will go above 7%, and it will really be at those levels. So maybe we will be moving towards the band of around 7-quarter type levels on the 10-year before we actually start getting more investors to come and buy on the 10 years. So what we are telling people is that from be in the short end of the yield curve. The basic idea is that don't have any papers, have maturities around 2 to 3 years is the time frame, is the average maturity that we are telling clients to look into. So that means up to the short-term bond fund, corporate bond fund, the floater funds, these are the funds which we are recommending. And depending upon the time horizon, investors should invest. So what we are saying is that if you're 3 to 6 months, if you've got time horizon, be in ultra short-term bond fund or money market, 6 to 12 months, be in low duration type of products. If you've got 1 to 1.5 year type of money, then you can be in short-term bond fund, corporate bond fund. So these are the banking and PSU. And if you've got more than 2 year type of thing, time horizon, then you can be in medium-term fund. So other than that, we are saying that don't look at investments right now in the long duration product, even though the rates are attractive right now. That's what some of this. We are seeing high rates. So after a long period of time, we are seeing rates which are higher. But there is still some room for yields to go up due to this huge borrowing program which has been given by the government. So these are our views. We are telling clients that, okay, the next year will be the time when if you are up to 1 year product and if you are sitting in this bucket, like we said, for a money market 3 months plus or ultra 3 months plus, you will get the YTMs of the product. Let's say that if you are, and if you are for 6 to 12 months, if you are staying in low duration product, you will get the YTMs at the time when you are actually invested. So for other things like short-term bonds and corporate bonds, we are telling clients that whatever is the YTM of the product right now, minus 10 to 25 basis points, there will be a hit on the you'll have to take a hit in the YTM because of rising interest rate scenario. But if you have got 1 year plus investment, you can get slightly more than what you're getting in low duration products or in money market funds by being invested in short-term bond fund or corporate bond fund. So right now, the view also is that the short-term yield curve may have some protection because RBI and the government will not target the up to 5 year segment in a big way in terms of supply. The supply pressure of this 14 lakh crores will predominantly be felt in the 10-year plus segments, and less than a 5 year segment should be relatively unaffected because the supply, the next 7 8 years, we are seeing that the redemptions is around 4 lakh plus continuously. So even now, even this year, the gross borrowing program is only around 11.6, but because of the repayments, redemptions, and maturities which are happening, that gets added. The addition is around 3.2 lakh. So that's why we are having this number of around 14.3. So the gross borrowing. So they would like to elongate the maturity, so the supply will be less on the short end. So that will not put pressure on the short term yield curve. And even when the credit growth picks up, most of the corporate borrow for 2 years, 3 years, or maximum 5 years. So the corporate borrowing and credit growth also should go smoothly as the yield, at least up to the 5 year segment, will be less affected because of rising rates due to higher borrowing. So that is a segment, the sweet spot we feel investors can be in. But there will be volatility in the segment. But our view is that if you are holding for those time frames, you can reduce the expectation of returns being too much out of line compared to the YTM of the product. So if you are staying for longer period of time in the 1 year plus products which I talked about, whether it is short-term bond fund or corporate bond fund, you should be getting the YTMs at which you have actually invested, minus 15-20 basis points because of mark-to-market hit. Most of the products which are being, which I'm telling for more than 1 year, they are all roll-down products. So right now the maturity is around 2 years. But over a 6 months time frame, 1 year time frame, it becomes around 1.5 year type of maturity. So that is the reason why we are saying that because of the approval and roll down, this will be better for investors to be.
Right, sir. Right, sir. Sir, do you anticipate rate hike next year?
What's the rate hike?
Interest rate hike by RBI?
So the point is that the Fed is expected to raise rates by 4 to 5 times in this current calendar year. The RBI is also expected to normalize rates. First objective will be that he will bring the reverse repo rate, which is at 3.35 to 3.75. Subsequently, we expect around 50 to 75 basis point of rate hike in the next financial year. Obviously, the idea is that so we are actually going back to the levels which we were before the pre-pandemic. Pre-pandemic, the reverse repo rate was around the repo rate was around 4.5 to 5% levels. So we should go to those levels. That is what we are seeing, because globally rates are moving up to control inflation. Even in case of RBI, because oil prices are close to around $90, and RBI will now, what is happening is that your inflation is in the upper end of the band of RBI for around 6%. The 2 to 6% band, which is in this band, but is in the upper end of the band. One. The second thing is that your current account deficits, we have been continuously printing a number of around 80 to 20. So that actually indicates that your savings is lower than your investment. So to increase so he will have to hike rates so that there is less consumption on imports. So basic idea is that once you start normalizing rates, you should be able to control inflation and be within a tolerant band. But given that our inflation will be in the 2 to 6% band, like the US will be hiking rates 4 to 5 times in the next year, we should be raising rates by 2 to 3 times. So that means we should have around 25 basis points, either 2 times from 4% on the repo, we will go to 4.5 or 4.75. We don't expect that RBI will move further than this right now.
Right, sir. Sir, thank you so much for your time. It was really interesting to talk to you. And thanks for the insight, sir.
Okay. Okay. Thanks.